So if you have a business owner who has really looked at all the alternatives and realises that the business in its current form simply isn't generating enough income to deal with accruing debt, perhaps there are doubts about the marketplace that the company is in, etc. In terms of an end of life type procedure, what would be the normal scenario there?
I think sort of typically there, we're talking about a Creditors Voluntary Liquidation. That's where the directors decide that in all the circumstances they can't pay the debts, and there isn't a viable core to the business that can be salvaged, and it needs to be shut down.
Right.
And that's a really crucial point in time anyway from the director's perspective.
Yes.
And if they don't take that action then they can become personally liable for the debts that they run up.
For continuing the trading when they should have known that there was going to be.
Those losses that they make after that point, and also those liabilities that they run up. There's a bit of legislation called wrongful trading that makes them personally liable at that point in time. So, I mean, the things that should make them aware of that is that possibly the bank's saying it's going to withdraw its facilities.
Yes.
Their accountants are telling them to stop trading.
Yes.
They might be bouncing checks. They might be being refused their trade credit accounts from their normal suppliers.
CCJs
coming through, even sort of threats of winding up. All those are indicators that they need to get expert advice quickly and act on it.
Right.
And the voluntary liquidation process is a calling of the meeting of the shareholders, followed by a meeting of the creditors, who agree to put it into liquidation, and then the insolvency practitioner.
So that's a process that the shareholders and directors control.
Absolutely.
Which has a degree of appeal.
That's right. I mean, they're in taking that action at that time. They're seen to be responsible directors.
That's right.
There will be a report done to the DTI on their conduct, but that would typically be clean if they're just done as they should do. There's nothing wrong in a business failing per se. It's really what action the directors take at the point they realise that that's where they are.
But if there is a situation where the directors feel that there's a part of the business that could go forward, can that be done, and do they have any risk in using a similar trading name, for example?
Yes, they do have risks in using a similar trading name. There's something within insolvency legislation, section 216, 217, that again would make them personally liable for the debts of that successor company if that failed and also went into liquidation. But having said that, there are exemptions in that if they buy substantially all the assets and goodwill and trade of the business, and write and give specific notice to all the creditors that have done that within 28 days, and advertise it in the London Gazette, then that does sort of relieve them of that potential liability.
Right. So that's all about getting the right advice from qualified person.
Taking the right action at the right time, and that's a way of salvaging part of the business whilst dealing with possibly other aspects of the business that were making it unviable, such as property leases that were sort of too onerous for the business to deal with, or possibly the workforce was too large, and the redundancy and associated costs were too big for that entity to bear. That process can be a rescue tool in that. Yes, the old business in its old form needs to stop, but that's not to say that there isn't a viable core that can be salvaged by the right person. And it can indeed be a third party. That's part of the liquidator's brief to get as much money as he can for the assets, and that could well be selling part of the business as a going concern.
And in a properly researched and planned situation, what's realised for all the assets hopefully will meet the costs of the liquidation.
That's right. I mean, obviously clear there is a cost. The liquidator gets paid first from realisation, so there's often not a cost to the directors
Yeah.
for taking that action.
Yeah, great.